Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak, your podcast available every morning on Apple, Spotify or wherever you listen. It's Wednesday the 16th of April in London. I'm Caroline Hepker.
And I'm Stephen Carroll. Coming up today, growing, gone. China's GDP beats estimates, but tariffs signal a looming economic cliff.
Bloomberg finds US importers are paying almost 100% of tariffs on overseas imports.
Plus, Donald Trump's push to reshape global trade is driving investors to Europe as confidence in the America First trade evaporates.
Let's start with a roundup of our top stories.
China's economy grew by a faster than expected 5.4% in the first 3 months of the year. The surprising strength in the world's second largest economy comes as concerns mount over the potential impact of 145% US tariffs on Chinese goods. Bloomberg understands Beijing is considering stimulus measures to cushion the shock of the American levies. Our Markets Live strategist Mark Cranfield says investors are closely watching how China chooses to respond.
China will have to be seen to be keeping up the stimulus for quite a long time. That's what investors will be looking for. They'll be looking for soothing words. President Xi Jinping is in Malaysia now. He's completing an Asian tour. He's trying to encourage a lot of support for China on a trade basis. That is something that investors will certainly respond to.
Mark Cranfield speaking there as economists at several international banks, including UBS, Goldman Sachs, Citigroup and Societe Generale, have all lowered their China growth forecasts in recent weeks to around 4% or lower.
The latest economic data out of China comes as President Trump called on Beijing to reach out to him as triple-digit tariffs threaten to effectively eliminate trade between the two nations. Here is the White House press secretary, Caroline Leavitt, reading what she said was a statement dictated by President Trump.
The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
Trump's comments delivered there by his press secretary come as China ordered airlines not to take further deliveries of Boeing jets. Neither side has offered much indication that they want to be the first to blink in a growing trade war between the world's two biggest economies. Speaking to Bloomberg today, China's former Deputy Finance Minister Zhu Guangyou said that the US had left them with little choice but to respond with their own tariffs.
We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything, maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because we don't want the whole world return to the jungle of jungle law.
That was China's former Deputy Finance Minister speaking there to Bloomberg as JP Morgan's Jamie Dimon once again waded into the growing trade war. Speaking to the FT, Dimon called on Washington and Beijing to engage with each other, saying it doesn't have to wait a year, it could start tomorrow, adding also that Trump's trade war is creating uncertainty that is challenging US credibility.
The Trump administration has banned Nvidia from selling its H20 chip to China, an escalation of Washington's tech battle with Beijing. Nvidia warned it will report a write-down of about $5.5 billion in the current quarter tied to the H20 chips. Shares in Nvidia fell by more than 6% in after-hours trading, and semiconductor stocks in the US and Asia have fallen after the news. Here's Bloomberg's Annabelle Drewlers.
This is important because it's a chip that Nvidia has created specifically to meet the export controls that are already in place on advanced technology to China. Now this brings this new technology into the fray. And so the concern from the White House and from the Trump administration is essentially the H20 is just too advanced, essentially. It can still be diverted or used to create some sort of supercomputer in China. That's the concern from officials.
Bloomberg's Annabelle Drewlers speaking there. Nvidia has said further tightening of restrictions will only reinforce China's determination to make itself independent of US technology.
To some breaking news this hour. The Dutch chip equipment maker ASML has reported first quarter bookings that missed estimates. The company saw bookings of €3.94 billion. That's versus $4.9 billion that analysts were expecting. ASML's CEO says that the US tariff announcements have increased uncertainty for the firm. The company's guidance is being keenly watched for the impact of the trade war, as President Trump has threatened to impose tariffs on the semiconductor supply chain. So ASML, of course, the leading provider of advanced lithography machines used to produce the smallest chips used in AI and other sensitive applications.
Donald Trump has launched a probe into the need for tariffs on critical minerals, citing national security and resilience concerns. The order signed by the president yesterday calls for the Commerce Secretary to investigate imports, including rare earth elements, considered the building blocks of US defence by the government. If the Secretary finds impairments to national security, Trump could impose tariffs on the suppliers, which would replace current so-called reciprocal duties. According to the White House, the US is import reliant when it comes to at least 15 critical minerals, while 70% of imports of rare earths come from China.
The European Union expects the majority of US tariffs will not be removed after making little progress during talks in Washington earlier this week. Bloomberg understands that the EU's trade chief, Maros Sefcovic, left the meeting with US Commerce Secretary Howard Lutnick and Trade Representative Jamieson Greer with little clarity on their position. Meanwhile, the US president's most recent comments on the matter this week from the Oval Office criticised the trading relationship between the two regions.
But the European Union has taken terrible advantage. They don't take our food products. They don't take our cars. We have millions of their cars, BMW, Volkswagen, Mercedes-Benz, many others. They come in by the millions. They don't take. There are no Chevrolets in Munich, I can tell you that.
President Trump speaking there. Well, in those discussions, US officials indicated that the 20% so-called reciprocal tariffs, which have been reduced to 10% for 90 days, would not be removed outright. The EU has said previously that its countermeasures on around 21 billion euros of US goods will kick in following the 90 days pause if discussions don't yield satisfactory results.
2 months into the trade war, US importers have taken nearly all of the damage. That's the view of Bloomberg Economics, which has built a tariff-inclusive import price index. It found that import prices had increased by almost the exact amount of the tariffs, meaning that exporters are not lowering their costs. Goldman Sachs chief US equity strategist David Costin says equity investors aren't clear which companies are going to cope with tariffs.
I think the bigger issue that investors really are focusing on is what is the growth prospects for the coming year. We're looking around 3% earnings growth. So if there was more confidence that you could have a better trajectory of corporate profits, that would be one reason for money to come into the equity market.
Costin adds that Goldman now sees the chance of a recession this year at 45%. The weaker dollar is adding to the higher costs from businesses importing from the EU, the UK and Japan.
Now, Americans are increasingly looking for jobs here in Britain as the US economic outlook gets gloomier. Job site Indeed says that interest from US job seekers is bouncing back faster than any other country. Bloomberg's James Wilcock has more.
If you go onto a job site and click on an ad, they track it. And Indeed say, of all the people abroad looking at jobs in Britain, nearly 1 in 10 of those clicks were from the US in the first 3 months of this year. That's the largest share in 2 years, and it's being driven by people looking for roles in scientific research. The shift comes as the US government announces billions of dollars of cuts to federal science projects. In London, James Wilcock, Bloomberg Radio.
Those are your top stories. On the markets, on Wall Street, equity markets were mixed. The Nasdaq finished up 0.2%. The S&P 500, 0.2% lower. We had Nvidia sinking by 6% in after-hours trade on those new China chip curbs. European stocks had a strong Tuesday close, with the stock 600 finishing up by 1.6%. Futures, though, today pointing sharply lower, down 1% for Euro Stoxx 50 futures this morning. The US dollar ending its 5-day losing streak, gaining 0.4% on Tuesday, but reversing that on the Bloomberg Dollar Spot Index today. Treasuries gaining for a second day in a row. The 10-year yields declined 4 basis points today. They're down another one at 4.33%. And we had gold prices hit another record high overnight, up 1.8% on the day, $3,288 a troy ounce.
Those are the markets. In a moment, we're going to bring you more on the latest economic data out of China, plus bring you our latest reporting on how European markets are winning from investors moving out of US assets. But maybe, Stephen, like me, you need some inspiration to do your daily toil to get out of bed today. Absolutely love this
toil,
piece.
Caroline.
Yeah.
We love being here. I
do love being here, but the thing that surprises me every morning is when I go to bed, I think that I've read all the news, and then I wake up in the morning and so much has happened in those few hours that I've been asleep.
One good way to escape the news? Go on a cruise.
Yes, exactly. And one of our colleagues has been writing about this. So it's not just any old cruising, though. This is cruising for real holiday snobs. Forget the kind of mass market thing, massive sort of buffet. Bloomberg's Fran Golden has been writing about the boom in ultra luxury cruise ships. These are the ships that have between 100 and 950 passengers. She's got lovely photographs. It's spacious. There's beautiful pools, kind of endless champagne. Just sounds like what I need today.
And some of the big luxury names getting involved in this, the Ritz-Carlton, for example, Bernard-Arnault's Orient Express brand also getting in on the act too. They're even going as far as trying to rebrand it so that people aren't talking about it cruises. Anna Nash from Explorer, one of the companies involved in this as well, saying that the word cruise does have a slight mass market connotation, and she prefers to say she's in the business of ocean travel.
Oh, that sounds good. Anyway, it's a piece from Fran Golden that you can read about in Bloomberg Business Week, and you can look at the prices as well that she has listed.
Well, let's go to the Chinese economic data now. China's economy expanding at a faster pace than expected in the first 3 months of the year, but the outlook deteriorating rapidly due to Trump's massive tariffs. Our Asia economics reporter Katia Dmitrieva joins us for more. Katia, let's dig into the detail then. What does the data tell us? It looks strong on the face of it.
Yes, it is. And we had sort of a raft of data coming out this week from China, which gave us a really good look at what's happening. But of course, the problem is that it is kind of in the rearview mirror already and a bit backward looking. So what it did show, some pretty positive stuff. So GDP ticked up in the first quarter. It was up 5.4%. And that was led by production and consumption, which is kind of a rare mix when you're China. It's usually exports, production, but consumption actually had a really good period. It was actually the best since December 2023, and that was really because of government subsidies. So if you look through the data, home appliances and furniture, those sales were actually up 30%, which is astounding. So unfortunately, it is no longer likely the case because, as we know, tariffs came in, the highest tariffs in a century, and investors seem to be thinking about that too, because despite how positive the numbers were, we saw stocks actually extending losses in Hong Kong and China after it came out. So in addition to that, there was some not so great news from data that was not in the GDP report, but kind of came out at the same time, which is that property investment contracted about 10%. And even though the unemployment rate actually looks better, it's around 5.2 instead of 5.4. It's still a bit too high for some economists' liking.
Indeed. And so if the GDP and the other data is sort of backward looking, let's think about the cliff edge, the damage that tariffs could do and are doing now, really. Can China get to that 5% growth goal?
That is the question. That is a very good question. And there's two camps that are kind of developing around that. So one says no, and we've seen that from UBS most recently. They revised their growth outlook for 3.4, which would be a pretty big miss from around 5%, which is what Chinese officials have targeted, which is the same as 2024. And they've joined Goldman Sachs and Morgan Stanley and a number of other banks that say that this 5% growth target is just, there's no way with this level of tariffs and with such a export dependent economy that still hasn't really gotten the consumer part quite right yet. But then there's also a camp of experts, and these are folks, China watchers, who've been watching this economy for decades, for their entire careers, who say, well, we have to remember that China has said they want to get around 5% growth. And in the past, they've been able to get it, except for, the pandemic, which no one could really expect. And so they're going to get it, whether it's through more government subsidies or trade agreements. She is currently traveling around Southeast Asia. There's a group of European officials coming over this summer to China. There's a thought that no matter what, they're going to have to orchestrate something.
Katia, what about the hopes for any talks over these tariffs? We heard Donald Trump say that he's waiting for China to reach out to start negotiations.
It's basically a game of chicken right now, and it's whoever blinks first, right? So we have Trump saying, I think over a dozen times since he was elected, she really wants to have these negotiations, and he really wants a trade deal badly. And, the press secretary just there saying China wants and needs to make a deal with us. We don't need to make a deal with China, but China is kind of saying the exact same thing. And China, for at least the near term, kind of has the upper hand because U.S. consumers are going to be feeling the inflationary effects. U.S. businesses, that Bloomberg Economics report saying that U.S. importers are facing the biggest challenges and payment sort of pain right now. They're going to have to, at some point, come to the table. They have not spoken yet. So the president, U.S. president, Chinese president have not spoken yet. So until that happens, that will be the big trade agreement to watch. But so far, doesn't look likely.
Katia, thank you so much for being with us today. Bloomberg's Asia economics reporter Katia Dmitrieva.
Donald Trump's push to reshape global trade and security has shocked European markets into life, driving investors to assets from stocks to bonds and the euro in a way that few could have imagined just 6 months ago. Joining us now for more, Bloomberg's FX and rates reporter Alice Gledhill. Alice, good morning. Talk us through, first of all, the scale of this move into European assets.
Good morning. Yeah, it's been a fascinating start to the year for European assets. So for a long time, European markets were viewed as this slightly sort of sluggish backwater where growth was challenged for such a long time. We quote an investor in the piece who describes European markets as this museum. But she said, this year, this museum suddenly burst into life. So you've got the euros at the strongest in 3 years against the dollar. Last week, you saw this huge sell-off in treasuries. German bonds were resilient, and European shares have been knocked by the trade war, but they're doing very well this year. They're proving far more resilient than American ones. And I think there's a few things going on here. I think you've got to push out of US markets, but also a pull into European markets. So just in terms of the US, I think, Donald Trump's sort of unpredictable tariff policy and fiscal policies have forced investors to start thinking about whether or not the US treasuries and the dollar are going to be the haven they've been for decades going forwards. And then in terms of the pull into Europe, a month ago, we saw Germany announce this huge fiscal package, which I think will be a game changer for the region's growth. So investors are suddenly thinking very differently about European markets.
Yeah, it is extraordinary, isn't it, that US exceptionalism is sort of faltering, that there does seem to be a question mark hanging over US dollar dominance.
Yeah, it is extraordinary. But I think there is a widespread acknowledgement that we are in the middle of a regime shift for global trade and markets here. Just thinking back to late last year, it was all about Trump and it was all about US exceptionalism and America first. And that's kind of all anyone wants to talk about, sort of the hot AI stocks, the ascendant dollar, king dollar, wave of tax cuts and deregulation. But last week you saw the dollar, US government bonds, US equities all selling off in tandem. And that's something that you see more often in an emerging market, not the US. But, I think clearly the outlook is tricky for the US here. There was a Bank of America survey out this week that found a record number of respondents are going to cut their exposure to US stocks. Markets have stabilized a little bit this week, but, some of the price swings in US treasuries have been so severe that markets are on watch for intervention from the Federal Reserve. But in comparison, you've seen European bonds and the euro really acting like a haven. And let's not forget, Europe is a large liquid market, and I think it does have capacity to absorb a lot of these flows out of the US. The EU is also a lot more resilient than in the past, and you've seen evidence of that in markets in terms of some of the periphery countries. Their yields have been much more anchored than you might expect during the recent volatility. Europe does have its challenges, but I think there's a lot more optimism over the long term.
This is Bloomberg Daybreak Europe, your morning brief on the stories making news from London to Wall Street and beyond.
Look for us on your podcast feed every morning on Apple, Spotify and anywhere else you get your podcasts.
You can also listen live each morning on London DAB Radio, the Bloomberg Business app and Bloomberg.com.
Our flagship New York station is also available on your Amazon Alexa devices. Just say, Alexa, play Bloomberg 1130. I'm Caroline Hepker.
And I'm Stephen Carroll. Join us again tomorrow morning for all the news you need to start your day, right here on Bloomberg Daybreak Europe.